Hey, Steve Sretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. This week, I wanted to touch on the Canadian real estate housing data, as well as Chinese capital flight, and as well as just really overall understanding how capital flows in the financial system. I think it's incredibly important to understand how money moves, why it moves, etc. That it is all has similar knock-on effects, and it is all tied and correlates together quite nicely. So I'm gonna try to bring that whole picture together. But if you start from just Canadian housing data, sort of another sluggish month of June for Canadian housing data. But I think there's one clear unanimous conclusion is that there's clearly a divide in Canada between the East and the West in terms of what's happening in the housing market. So on the West side, you obviously have Greater Vancouver. I think everybody here knows what's happening there. A very sluggish housing market in Greater Vancouver. You have weakness in Calgary and Edmonton, Saskatchewan, Saskatoon. Those markets are extremely weak. And then you go to the east, and it's sort of like a totally different story. You have the Toronto housing market, which has stabilized, at least for now. Prices are actually growing. There's actually some growth in home prices in Toronto. Ottawa is rising. Montreal is showing price growth. Even New Brunswick is showing strength in their housing market. So you have a clear divide between the east and the west. And all you have to do is look at this chart here, which basically shows the Terranet home price index. Granted, it is a lagging indicator, but you can clearly see there is some divide between what is happening between Eastern Canada and Western Canada. And a large part of that has to do with how capital flows and how banks do business. So all you have to do is talk to any lender that actually manages and moves money and issues new debt. Is they issue it on the basis of confidence. So if the bank is basically confident that prices are rising in, say, Montreal or Ottawa, then they'll continue to allocate new funds and resources there. Whereas if you go to Vancouver, why would a bank want, if they have the option between lending in Vancouver and the option of lending in, say, Ottawa, they look at it from a risk perspective and which one appears more stable. They look at Vancouver and they can say, okay, well, why would I want to issue a new loan on a single family house in Vancouver when prices are declining at a 15% annual basis? Same thing in Calgary. The Calgary and Edmonton job prospects are quite bleak. The economy there's really not much confidence there. There's a lot of disgruntled people. Why would a bank start issuing a whole bunch of loans there, especially if people have no desire to actually borrow that money? So again, it flows back to Eastern Canada, and it's the same thing from investors. I personally have investors that I work with here in Vancouver that are allocating money into Montreal and Ottawa, and it's the same story that I'm hearing when I discuss with mortgage investment corporations. They had funds in Vancouver. They've now shifted them over into other parts of Eastern Canada. So again, that's just, you have to understand there's so much capital that is just basically sloshing around that this money has to go somewhere, and a lot of it is going to, quote unquote, the safer havens, the areas of growth, and it certainly is exhibiting areas of growth into those regions. For really obvious reasons. It's like as long as prices are growing, they'll continue to attract new capital, and so it's the same reason. Not to get all finance perspective on you, but like if you look at the U.S., you say, well, how come the U.S. You could argue the stock market is overvalued, but there's all this capital that's sloshing around, and the U.S. is the cleanest shirt in the dirty hamper bin. And so capital is basically just continues to flow into there, because where are you going to put it? Europe's a mess. There's 13 trillion in negative yielding bonds. So this money has to flow somewhere, and the central banks have created this ultra loose monetary policy regime where all this credit that is just sloshing around again needs to go somewhere. So I think that's important, and you can really distinguish that into the real estate markets. Just to give you an example, one of those ones was Chinese capital. So China embarked on the single largest credit binge in financial history by far. And so all this money that was created there had to go somewhere. Of course, it chose to exit out of the country for really safety reasons and a hedging reason to get money out of the country. And a lot of this has a cultural bias towards real estate. So naturally we saw Vancouver real estate, but we also saw this in other property markets such as Australia, United States, etc. Well, all you have to do is look at the US. So the National Association of Realtors chief economist just reported per their data that foreign investment into US real estate dropped 36% year over year. The single largest decline in foreign investment came from the Chinese, where the amount of dollar volumes purchased by Chinese buyers declined 56% annually. And so you have to, and again, think about this: there's no foreign buyers tax in the U.S. There's no speculation tax. There's no empty homes tax. Is free reign. And so just to see that amount of capital pull back is because this was unsustainable capital flight to begin with. And China, of course, is dealing with their own problems, not only a trade war, but recording the slowest GDP print at 6.2%, if you even believe those numbers, since 1992. So clearly that was something that I had warned about. So if you look at the US, all you have to do is look at the two largest foreign investors into US real estate are actually Canadians and the Chinese. The Chinese have recently surpassed Canadians as the number one investor of US real estate. But all you have to do is look at the amount that Chinese investment has increased into US real estate. As you can see here in this chart, is these flows of Chinese money into US real estate actually peaked in 2017 at $31 billion. They have recently declined this year to 13 billion. So it went from 31 billion to 13 billion. So again, clearly an unsustainable movement of Chinese capital flight, which could not be sustained. And I think that's a huge reason of why we are in this sort of dilemma here in Vancouver and parts of Canada, particularly Vancouver. And this is something I talked about in my videos when I first started doing them in 2016. I said, what if, because everyone that you would talk to in 2016 said, oh my gosh, there's so much demand, everybody wants to live in Vancouver, you just need to buy, prices continue to rise, this is like crazy, we're not building enough homes, oh my gosh, what are we doing? And I said, what if this euphoric boom in 2016, which has been no doubt propelled through Chinese capital flight and of course excessive domestic lending, because everybody wants to participate in a euphoria. What if these flows are not sustainable? These are foreign investment flows which can get turned off at the snap of a finger. And lo and behold, that was never really calculated. So what did we do? We built luxury single-family homes that sell at $3, $4, $5 million. Developers built condos that were pre-selling as high as $3,000 a square foot. And of course, these taps have now turned off. This is again something that I said. Like, all you have to do is it's not that this is some smart prediction. It was just merely all you have to do is read financial history. So there's a good book, Manias, Panics, and Crashes by Charles Kindleberger, that shows that every sort of financial euphoria is stemmed or at least facilitated by an inflow of foreign credit, which helps boost that, and then basically banks participate. This is basically the single most common recipe in every single financial mania that has come to existence. And so, where does that leave us today? Well, whether it's Chinese capital flows, which I think is the majority, at least in Greater Vancouver, there's no doubt been a reduction in foreign investment. And I think that clearly, as we can see it in the US, I don't think this is necessarily a direct result of the, taxes and regulations that the BC government is to stem foreign investment. I certainly think it has exacerbated the decline in foreign investment into BC, which we can see has basically plummeted ever since they started collecting data in January of 2017. It's been a continuous trend down and to the right of foreign investment dollars spent into BC. So, but again, this it just amazes me from really just a observation and a student of really just an interest in finance, particularly in global, as I'm sure you guys are all aware of, just to see how the capital flows and moves. And I think that you really need to understand how and why it moves. And there's a multitude of reasons for the Chinese money moving. There's a multitude of reasons of why it is slowing today, and that has impacts on everything, not just tiny little Vancouver real estate, but also simultaneously, it's like you can look at Canadian investment into U.S. real estate. That has declined. Well, again, why has that declined? So this is all part of the bigger picture. So I thought I would bring that whole piece together today to sort of share my thoughts on that. It's interesting to sort of see it all come together because clearly, the Chinese credit euphoria could not go on forever, and certainly the exodus of capital flight could not go on forever. And as we're seeing it now, really start to tighten up, particularly as they engage in a trade war and they need to beef up their capital reserves in order to maintain their financial system. So, anyways, that's where we're at today. I hope that video helped. Otherwise, see you next week.